I think there is a real threat that AI presents to software. There is no denying that.
The AI trade is killing software stocks. What should investors be doing right now?
Try to find the companies that don't need to make this outsized capex investments.
We've got Ivana Delevska, tech investor who's been outperforming the markets. She spent her years honing her skills at some of the biggest hedge funds on the planet, including Citadel, Millennium, and Tiger. What is happening to the AI trade? Do you think that the sell-off we've seen in software is overdone? You really could not ask for more in the Shopify results, and yet the stock was punished. Did the market get that right? When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James Advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The content in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The hosts and guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions. In this episode, we discuss Constellation Software and Micron, which are both stocks that I own. Hey everyone, welcome to a new episode of In the Money with Amber Kanwar. I'm going to give you guys one more week to vote on what our new piece of merch should be. As you know, over the last month, we have crowdsourced your ideas. What should we put on a mug? What should we put on a hat or a sweater? And you guys really rose to the occasion. Now it's time to vote on the best ideas. And then that's going to be our next swag giveaway. So get voting. The link is in the show notes wherever you are listening. This episode comes at a really pivotal time for tech investors. Tech has basically been a one-way trade higher for years, but something interesting is happening in the markets. AI used to be the thing that's lifting the entire market. Now, AI's kind of hurting the market, specifically in software. Those stocks are bleeding right now. The index is down 30% from the September peak. That's a new bear market. Where is the bottom? Is any of this overdone? Should you be buying the dips or should you be getting out of the way? We've got Ivana Delevska to answer all of those questions, and she's really thoughtful about where the AI trade is best expressed right now. And by the way, she started her fund only a couple of years ago. She's outperforming the NASDAQ, which, as I said, is kind of a big deal right now because it has no longer just become a one-way trade. So let's get into it. Ivana Delevska, thank you so much for joining me on the podcast.
Thanks for having me, Amber.
So we have to talk about, you are a tech investor, you've been an AI investor, and all of a sudden, something really interesting is happening in the market. AI, which has been such a boom to the broader market, now seems like it's hurting the market. And all these software stocks are getting dumped out. What is happening to the AI trade?
Well, Amber, that is a great question. I think investors over the past 3 years have been viewing AI as a single trade. So you really had a list of stocks, 10 to 20 stocks, whether it's hardware, software, applications, all trading together in one, right? Over the past year, or even more recently, 6 months, it's become clear that not all companies will benefit the same. So we're starting to see real divergence between the hardware layer, and you're still seeing billions and billions of dollars in capex being poured into hardware and these other layers like software, where we're seeing a lot of companies come under pressure. And it's really broadening just from software to even industries like financials. There was an announcement that of a new AI tool that shook the market, tracking a new AI tool that shook the market. So I think we're going to see a lot more of this to come. We think that it's going to become even more important than ever to pick the right places you want to be invested in the value chain rather than just get broad exposure to the trade.
And you're absolutely right. Everybody's afraid that AI and all its new tools are going to eat into the software business. It wasn't so long ago that software was eating the world. Now it looks like AI is eating software. Do you think that the sell-off we've seen in software is overdone? Or is it a correct expression of what AI, of the threat that AI represents?
So I think there is a real threat that AI presents to software. There is no denying that. I think where things are overdone is now investors are treating software as one and everything is selling off. So for now, I think you want to stay away from software and try to find these gems and try to start doing the work on it. I think it's still too early because I think there is still more air to come out of the trade. The reason why we're seeing this is software has traditionally been seen as a very stable business. These SaaS models really give you visibility 3 to 5 years out because a lot of it is long-term contracts. Well, now what's happening, especially on the application side, is that you can come up with these applications as a competitor relatively quickly using the new AI tools. So some of these software tools that looked new 5 years ago now look like dinosaurs. And that's structural. So you don't want to be positioned on the wrong side of this trade. So I think over time, we're going to start talking about churn rates. We're going to start talking about pricing pressures. And really, once you see that come through and stabilize, that's the time to look at applications, right? Now, on the flip side, there is software infrastructure. The types of companies here are either companies providing cybersecurity. They're providing the platform that these new entrants are building on top of. Those stocks are selling off as well. And I think this is where the opportunities are in the near term. So as we go into the second half of this year, we've reduced our exposure to cybersecurity, for example, significantly just because it is software and it's going to trade down. But this is where we're looking to be adding exposure and adding new ideas.
Okay, so that's really interesting. You are looking for opportunities in software, but not yet. And in the meantime, the obvious AI trade has been Nvidia, and that's not really doing anything, right? It hasn't sold off in an extreme way, but for about 6 months, it's basically flat, even though there's an explosion. There are literally trillions of dollars that are going into building out AI infrastructure. Everyone thought, okay, the next place to go is software because that's the area that's going to see the return. Obviously, that's not it. What's in the middle? If it's not the chips, if it's not Nvidia, and if it's not, software, where do investors go to capitalize on this?
So you're spot on, Amber. I think where you go is down the hardware value chain, right? So Nvidia makes the chips and they're going to really capture a lot of the dollars spent on AI. But a lot of that is known. And that's why you're not seeing the stock perform in an outsized way, the same way it was doing, let's say 2 to 3 years ago, where nobody even knew about the AI trade. So I think a lot of it is priced in for Nvidia. I think they're going to keep beating earnings and the stock will go up commensurate with those beats, but it's not going to double. It's not something that like nobody has heard of, from here. The places where we've been finding a lot of outsized opportunities is further down the value chain. So networking is one area where some of these cycles just turned 6 months ago. Optics is one example. Optical components, they really provide the connection for data. So that's one area. Another area further down the value chain is to go into semi-cap equipment. So now that a lot of these markets like memory and chips have tightened up and we're clearly seeing the demand for them, it's clear that we need to add more capacity. And this is another cycle that was really muted over the past 2 years and just turned 6 months ago. So this would be companies like Applied Materials, Lam Research, KLA. So they basically make the machines that produce the chips. And that's, I think, a safe area or a good risk reward, to be invested in right now. So to step back, I think the idea is that all of these billions of dollars of capex that are getting poured into AI are going to end up going somewhere. And I think that's going to be in the hardware value chain.
And we're going to talk about your top ideas because they absolutely are in that wheelhouse. And just to, give you credit, in an environment where the NASDAQ is only up 14% over the last year, the ETF that you manage, the SPRX, has massively outperformed that. You're up 36% over that time. So I'm just going to plant that there so that people know when you're picking those stocks, that you do have that track record over the past year of outperforming. Before we get into the mailbag, because we have so many questions that people want answers to, I want to talk briefly about the financing environment. This is an area where there's some anxiety that all these companies, our traditional cash flow generating companies like Meta, like Google, now they're spending away all that cash flow. They're capital intensive. There are concerns about how much is private equity on the hook for this, and are they underwater? How much of this is financing from OpenAI, and how concerned should we be about the fact that can OpenAI continue to pay its bills, over the next 5-10 years? How do you think about the financing environment and that being a risk to the overall AI trade?
Well, I think that is a great question. I think it's something that investors should really focus on, because at the end of the day, it's all about returns on invested capital. So for some of these mega caps, you've gone through a phase where they've been generating outsized returns and not investing significant capital. And now that's switching to them not really generating outsized returns or earnings and investing significant capital. So we are really avoiding those companies for now. Some of them will emerge as winners, and at some point the returns, we believe, will show up. But you're in that investing stage rather than harvesting stage. So I think really that's why we're not really focused on some of the mega caps. I think the financing environment is very bifurcated depending on your credit. So Google has been able to issue debt at ridiculously attractive terms and rates, right? On the flip side, you have Oracle not doing so well in the credit markets with their CDS spiking, right? So I think it's really the credit quality is going to be very important. Whether you're partnering with companies with good credit quality is also going to be very important, because at the end of the day, there needs to be significant amount of investment. We think even more than we're investing today to be put in place for some of these ideas like robotics and autonomous vehicles to become reality. So I think there is much more to come on the investment side. I think credit quality is going to be a key differentiator for companies. I think what we're trying to do is try to find the companies that don't need to make this outsized capex investments, right? That's where you're seeing a lot of the real returns. Like if you look at companies like Nvidia, they're not investing significantly in capex. They're investing in R&D and staying ahead of innovation, but they're really harvesting more the returns on what they've been putting in place for the past 15 years versus some of these companies are on the opposite spectrum of that.
It's so funny. I actually wonder if Apple is going to come out the winner because it's just chosen not to spend a boatload on AI and just use, ChatGPT or whatever it is. They have no clear articulated AI strategy other than, I'm sure as AI evolves, you'll be able to interface with it on the iPhone. What do you think about that? Is Apple playing chess while everybody's playing checkers?
Well, it's going to be interesting to see. I think as of right now, they're not really the winner, right? So I think they really risk falling significantly behind. I don't see a way around capex spending here, right? Like if you are consumer facing, especially, or if you're even trying to enterprise facing, you're really going to need to put the capex in place in order to develop tools and applications that people actually want, or products, right? In the case of Apple. So I think they've been doing really well, mainly because of their installed base. Mm-hmm. So I think that's really difficult to sway one way or another. And there is not really great alternatives in the market, but they are, I feel like, vulnerable here, because if somebody is to come up with something new, the consumer is not really very sticky, right? They can change overnight. So while they have really large penetration, I do worry about Apple. I don't think it's a no-brainer here.
Let's segue that into the mailbag, because we have a lot of stock-specific questions. Investors want to know which software stocks they can buy the dip on. So let's get into that. Our first question, we actually talked about this off the top, but is Oracle. I do want to spend a beat on that. It can be so tempting to buy these dips and ask, when is the sell-off overdone? Oracle is bloated with debt, very levered to OpenAI. It's down 50% from the September high. But the question is, does that adequately handicap the risk to the balance sheet such that the upside they get from AI is not priced in?
Well, Amber, I think Oracle here looks pretty interesting, but it is very risky. So from our perspective, it didn't really meet our risk reward criteria, not because we don't see reward, but because we see elevated risks. And as you mentioned, credit is a big deal for them. OpenAI exposure is another big deal for them. There are positives on the other side that offset that, but for us, it's not been enough to underwrite an investment at these levels. I do want to mention, though, for viewers, that we do run a very concentrated portfolio. So if we don't own something, it doesn't necessarily mean that it's a bad idea or it's not going to generate returns. But in the case of Oracle, it's really more the risks that we can't quite get comfortable with, not necessarily the upside. I think the upside is there.
The number one stock that Canadians have questions about when it comes to software is the former darling Constellation Software. If you invested recently, like I did, you're down on a name that was pretty consistent in terms of its outperformance. Now it's trading at around a 3-year low. What point do you say enough is enough?
Well, as we discussed before, I think software is very, very tricky right now. I think you need to wait till the whole trade settles down, even on the names that are very high quality. Like one example is Cloudflare reported earnings 2 days ago. They literally beat on every possible metric, the best report that I've seen in a very long time. The stock was up 5%, right? So we're not really at a point where people are willing to give a free pass or be comfortable with the software trade. So I would say sit tight for now and look for better entry points in software. Again, it's not necessarily that there is no upside. I think there is going to be upside, but a lot of these names will actually get disrupted. And just in case, for the viewers that may not be familiar, what's been happening is Anthropic, an AI modeling company, introduced a new model that had an AI agent with it. And literally this agent can perform better tasks on Microsoft than Microsoft can itself, right? So all of a sudden, it's really disrupting Microsoft's business model. So people are wondering, wait a minute, if I can run this on a Microsoft tool, an application, I can do so much more with it. So all of these companies that provide like Salesforce type services, any company that provides operations help or logistics or communication help, I think all of those are coming under attack because with some of these newer tools, you can do much quicker and in a much more modern way, something that this now legacy software companies really seem like very outdated.
I think it's important to bring that up, the sea change moment that we've seen over the last couple of weeks as Anthropic has been just like dropping bombs and, financial software and legal software. Because the last time we had you on was when DeepSeek came out. And this was a Chinese AI platform that was built at a fraction of the cost. And I remember at that time, you kind of said, like, this is not a moment to freak out and to panic. Cut to today, where we're getting kind of this software apocalypse, and you're actually saying, yeah, you should be a little nervous if you're in certain sectors, right? It sounds like you view these two events as very different.
Absolutely. And I think the Anthropic thing is just step one. Basically, just to provide some context here, as we're shifting from one generation of hardware to the other, and this is specifically NVIDIA's Hopper to Blackwell and Blackwell Ultra, these models, this hardware is able to provide much better performance. And Anthropic is just the first model that happened to come out of that new hardware architecture. Everybody else is going to introduce newer and newer models, and they're going to just get better and better from here. So that's why we're concerned about software. On the flip side, we're not concerned about the broader AI trade because you're really going to have to plow massive amounts of capital to keep coming up with these models. Clearly, they're useful, right? If you can come up with a tool that mimics a company that's been in existence for like 10 plus years, clearly there is returns and opportunities to be created there. So that's why we're not concerned on the capex spending side. Anytime we hear, oh, it's a bubble, we think that we're really in like year 1, 2, 3 of a 10-year investment spending cycle.
And that's where you want to be. Again, those are some of your top ideas, and we'll get to it. But, you know, the point you made on Cloudflare was really interesting. You're absolutely right. I mean, it was a beat and raise quarter. It was beautiful across the board, and the stock didn't even rally. Contrast that with our next question, which is on Shopify. Investors are nervous that it can't grow 20%. Guess what? It grew 30%. And then it said, oh, we can do that again. And we're generating free cash flow. And we're going to do a buyback. And then the stock fell 10%. And we're getting benefit from AI. Like,
you can't ask for more.
Yeah,
exactly.
Like you really could not ask for more in the Shopify results. And yet the stock was punished. Did the market get that right?
I think on one hand, yes. On the other hand, no, right? It definitely, the report deserved at least 10, 15% move up in the stock price, right? Versus where expectations were. But I think what investors are doing, they're now comparing these higher multiple stocks, which are higher multiple for a reason, like Shopify, like Cloudflare, to some of the stocks that are now trading below 5 times, below 2 times revenues, right? And the disparity is very large from 20 times to 2 times, right? So this is why it just seems like there is no bottom in sight for them. And this is why we're trying to kind of be patient and try to find good entry points here rather than blindly buying. But I would say if you look at software, companies like Shopify, they're really providing the operating system for retailers. They exist because retailers don't want to do this on their own, right? So I think that business is much less likely to get disrupted no matter what tools are coming out, because literally every tool that comes out, they're offering it through Shopify for not a lot of money, right? So I think if you look at like on the spectrum, I would highlight them, Cloudflare, Shopify as some of the better software opportunities. But even for those, I think you're going to have to be patient for them to work from here, because we do need to rebase the entire sector at a level where investors are now comfortable to step back in.
Let's apply the valuation conversation to our next question, which is Snowflake. It's an AI data cloud vendor, and it's been growing market share. A lot of big companies use them. It's down 37% from the November peak, and it trades at, here's the headline, 142 times earnings, which is, that's when you talk about a high multiple stock, like let's apply that to Snowflake. Do you think ultimately it's the valuation that keeps people on the sidelines, despite the fact that they clearly have a strong business here?
Yeah, absolutely. I think the valuation is going to be a big pill to swallow here. Like, I think a lot of these companies are going to really need to not only show growth and progress on their business, but then trade somehow in line with the rest of their peers. I would also mention that there is a lot of innovation going in this integration layer. So while in the past it was only Snowflake and Databricks, we're now seeing that as a potential opportunity for new entrants. So I think this is something for investors to really keep an eye on, because a lot of these leaders that we consider today, like Snowflake would be a leader in this data layer. A lot of those may also get disrupted. So we're seeing a lot of change. I think it's very important to stay on top of the dynamics. We still see it as attractive today. It's still a very high quality company, but we've really limited our exposure to the entire sector just because of the points we discussed.
Yeah, it seems like you're making a difference between like you can like the company but not the stock right now because it's just not the right environment. And I mean, we can apply that to maybe even Palantir, which was such a darling. It's down as well, about 37% from its peak a couple of months ago. Another high multiple stock with a big cult-like retail following. Does it fall victim to the same sort of like software apocalypse?
Yeah, absolutely. I mean, with Palantir too, like if you look at over the past 6 months, the business has actually improved, especially since they're so levered to defense, and defense spending is really booming. So from fundamental perspective, you could argue things have gotten better. So the problem for Palantir is the valuation, right? So if you look at the business itself, the business has actually improved over the past 6 months, with this defense spending booming and them being one of the primary beneficiaries. But if you look at the valuations, it trades, forget about 20 times, it trades double that, right? So that's really what the worry here is, that sure, it can trade at a premium to the rest of the software names, but if you have names trading at 2, all of a sudden paying 2 times sales, all of a sudden paying 40 times seems a little unrealistic.
We should ask about Nvidia. I know we talked about it off the top, but probably a core holding for a lot of people who got in during the AI trade and have just seen it do nothing for 6 months. What should shareholders do with Nvidia at this point?
So I think, Amber, Nvidia is very interesting here because it's gone from an offensive play to a defensive play. And I think it still looks very attractive here, but for different reasons. So we think that if you looked at the stock 2-3 years ago, there was massive upside to earnings. So they were beating by 50-60% on the street numbers. Now it is no longer possible to beat by such wide margins. So they're still going to be able to beat, and the stock will still go up on that, but you're not going to see the same type of returns. So on the flip side, there is significant valuation support. It's trading in the 20s on EV/EBITDA basis, and these stocks rarely trade below 20. So no matter what happens to the AI trade, you really have good valuation support here, because we think the numbers, there is really no way for them not to be growing from here based on the capex that we're seeing from the hyperscalers. So I think for us, it used to be our top holding 2 years ago. Now it's not even in top 10, right? Wow. But we still do see decent returns coming out of it. The question is going to be, does it deliver outsized numbers? I think the answer is probably at some point, but you have to be patient.
Let's end the mailbag with Micron. The baton has been passed from Nvidia to these memory chip makers. We've seen a parabolic move. So the question is, if you missed that parabolic move, can you buy it here? And maybe before you answer that, let's just give context. Why all of a sudden is there an explosion in memory stocks?
Yeah, so Amber, you're spot on. Basically, the baton has been passed, and the reason is because you really generate most of the returns when things just start tightening up and nobody is caught on to the trade. So this was the case with Nvidia 3 years ago, right? And it literally was the case with Micron last year. And the way this works is basically memory is extremely supply constrained. People weren't investing in adding additional capacity just because this is a very volatile and cyclical market. So a lot of the AI memory that was required was coming out of other types of memory that weren't really doing so well because of cyclical downturn. Well, now what we're seeing is that all of that capacity has been absorbed, and you're seeing a real squeeze in pricing. So I think this pricing and strong fundamentals are going to continue. but it's becoming a lot more risky here for people to get involved. We're not involved for that reason. What you do see a lot of times when stocks and prices spike up like this, there is a lot of pre-buy that happens. And that's what we're trying to get smarter on here. How much did companies pre-buy knowing that this spike in prices was coming, and how will that affect the cycle? A better place to be is now one step further, right? So we're passing the baton from components, which one would be memory, to capex equipment. So semi-cap equipment is where we're seeing the next leg up in this trade. So it's really important to stay on top of these supply-demand trends. AI is not one trade, as we discussed, right? So you want to be at the places where there is a lot of demand and not enough supply.
And we're going to talk about those ideas. Let's get into your pro picks. Pro Picks is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information. Okay, before we get into your top ideas, you were on with us January 28th in 2025, and your top ideas at that time were Constellation Energy, Nvidia, and MRVL. Constellation Energy, peaks and valleys, it's flat since that time. If I recall, it was a play on all the energy that was required to fuel the demand for AI, the power demand. Do you still own it? Do you still like it here? It is flat over the last year. So what do we do with Constellation Energy?
So with Constellation specifically, we took significant profit, mostly because the narrative shifted from you want to be invested in power to you want to be invested behind the meter. And I'll explain a little bit what that means. Basically, power is going to be the main bottleneck for AI growth, not in the next 2 to 3 years, but in the next 5 years, right? So that's really where you want to be focused on to find opportunities. Now, what's been happening as well is that as electricity prices are increasing, all of a sudden there is significant pushback on the power generation companies to not increase prices. And that's really the biggest concern for some of the IPPs. Constellation is the one that we like the most, but we really exited just because of these concerns around, well, sure, power is going to be important, but will they be able to increase prices and generate returns? So we've replaced Constellation. We still have a small position, and we disclose all of our holdings on our website, and we're looking for a better entry point, but we've replaced it with companies that now have secured power generation and land, and now they're trying to sign up customers sign up agreements with some of the hyperscalers on a long-term basis. So you want to be invested more in the behind the meter. So this would be power facilities that are not necessarily dependent on the grid, and avoid the grid basically for the time being until there is more certainty around how much can they actually increase prices to the consumers.
What's an example?
So an example would be TeraWulf. Some of these old Bitcoin miners, they had secured capacity for Bitcoin mining, and they had kind of done a lay of the land and figured out where are all the underutilized power plants in the US. And they basically have a backlog either of projects that they're currently building or potential contracts that they can sign. So this is really these stocks are very volatile in the market. But if you look at their business, it's not actually volatile at all, because what they're doing is they'll secure the power, they'll secure the land, and they sign a 20-year contract. So you're really getting an annuity based on the terms that they secure. So if you like it today, you should like it for the next 20 years. And they're going to start trading, in my opinion, much more similar to the traditional data center REITs. The business model is not different at all. So there is an opportunity for significant re-rating from here. So I think it's important to go to places that are not as well understood by the market, rather than I think what worked, let's say 3 years ago, is like, hey, I like nuclear, I like power generation. You can just buy a basket of those companies that have exposure to that sector.
Okay, so you took profits in Constellation Energy, pivoted to, the TeraWulfs of the world. Nvidia, we've already talked about, still like it, but the best gains probably behind it for now. So you own a modest position, and you had a nice gain in Nvidia over that year. Talk to me quickly before we get into your top ideas about MRVL. This one is down over the course of the year. Did you also harvest profits there? Custom semiconductor maker. So instead of just buying everyday chips like you might get from an Nvidia, MRVL makes custom ones for custom functions.
Yeah, absolutely. So we did, and we're looking to re-enter or size up our position here. We think they're very well positioned on the Amazon chip. And as you saw, Amazon is spending from 150 billion to 200 expectation for 2026. So they're really levered to this trade. They have struggled a little bit in that a lot of these hyperscalers introduced their ASIC or their custom chip, but they haven't been able to scale it up the same way Nvidia has been scaling up their chips. So the ramp has been slower, which is why you see the stock not gone anywhere for the past year. But I think there is more to come here, because networking is going to be one of the most important ways of getting performance improvement from this chip. So I think it's a really good place to be.
Let's talk about your top ideas now. You said you want to be in networking, capital equipment, and that's what you've brought us. The first idea is coherent, optical components, AI networking. And boy, the stock has held up very, very well. Talk to me about why you like it and how much upside you see from here.
So Coherent is a very cyclical stock, and the cycle just turned for it in the middle of last year. So when you look at its performance, it's really more driven by the fact that it came from very low levels of from cyclically depressed levels to now being one of the leaders in optical solutions and optical components for these hyperscalers. The cycle, I think it's very important to highlight that this is a bit of a new theme, right? It just turned last year. So I think we're here in the very early innings. We, Amber, as a rule, when we underwrite an investment, we look for a stock that can compound by over 20% each year and double every 5 years. So that's usually our threshold in terms of target price. So for Coherent from today, it still meets that criteria that can double over the next 5 years.
And even though it's run up so much, I mean, you're right. It was like a very flat stock for years, and then it went parabolic. Help me understand the valuation, and does valuation still make sense?
Well, the valuation still makes sense because we're going to see significant earnings reacceleration. They're introducing a new product in the second half. I think it's going to be even stronger performer in the second half of this year. So from a valuation perspective, the stocks were really beaten up last year. Now they're reflecting significantly, they have significantly higher multiple, but that's because we are expecting almost doubling in earnings. So from that perspective, we still think they look very attractive.
Okay, Coherent ticker COHR. Your next one is KLA Corp. This is semiconductor capital equipment. You mentioned Lam as another one. Those I guess would be peers, but KLA, it makes and it distributes semiconductors, has also had a nice run.
Yeah, this is another cycle that turned in the middle of last year. A lot of these stocks have had a nice run, but nothing compared to the way they perform over a cycle in the past. So the main players in semi-cap equipment would be ASML. They make the big machines. And then KLA, Lam Research, Applied Materials, which reported today, they make the etching and deposition. So basically, when you make the chip, you need to add and subtract parts to it. So this equipment really is going to be the next leg of the trade, because as we grown so much, we're starting to become we're starting to be constrained on capital equipment. And that's when you start seeing these things. Like, to give you a sense, they are still even like they're just starting to grow earnings. And for ASML, it's really more 27 that is going to be the year. So we're very early in the semi-cap equipment cycle. The stocks have moved ahead of it, but nothing compared to the way they usually move throughout the cycle.
Okay, so the last two have already had big moves, but still meet your criteria of doubling in 5 years, or you think it can still double over 5 years. Let's contrast that with Arista Networks, which has actually kind of stalled out. It looks kind of like Nvidia over the last couple of months. Another AI networking company. Why has it stalled out, and why do you like it?
So Arista Networks has stalled out because they reported a quarter where they came ahead of expectations, but didn't quite have a blowout numbers. This is because there is a lot of timing that goes with their projects. Some of their projects are very large in size. So depending on when they get announced and when they get executed, you really see the difference in performance. So we think this is actually a very attractive entry point for the stock because of the reasons of it having stalled out. They're a leader in networking. Again, this is where we see a lot of the upside. And the fact that it stalled out provides a really good valuation, entry point from a valuation perspective.
Talk to me about margins. I know that's a concern when it comes to Arista, its ability to kind of preserve margins and not get squeezed by its customers. What's your outlook there?
So I think investors are overly concerned about margins, not specifically only for Arista, but for the sector more broadly. I think what's happening for a lot of these companies, what they do is hardware that has embedded software in it. So when they do more of a software product, their margins will be higher. And then when they do more of a hardware product, their margins will be lower. The returns on hardware are equally, if not better, than software. So it's not necessarily bad, but because mix is changing, you're going to see margin pressure. It's not necessarily coming because customers don't want their products anymore and they're trying to like compete them against other players. It's really more the mix between hardware and software. So I think that's something for investors to be mindful of, because from high level, usually when you see a stock that has margins kind of stalling out and declining, it's a red flag. But because here it's driven by mix shift, we're not as concerned.
I mean, just to give people perspective on how fast a company like Arista is growing, 2023, $6 billion in revenue. This year, it's expected to do 11, right? So almost doubling in just 3 years. How high do you think that number gets? Like, what does the top line look like in 5 years?
Well, it's literally driven by the capex growth and a multiple of that. So I think that's really like, if you see continued capex growth by the hyperscalers, if you see continued growth specifically for them, important are also enterprises spending on AI. You're really going to see the numbers continue to grow at this or maybe even a higher rate.
That's a good point. Before we close out, we're sort of taking all these capex spending plans as law, right? They said they're going to spend it, so they're going to spend it. Is there a risk that this spending is either lower or doesn't come to fruition? I mean, that certainly hasn't been the trend, but do you have to think about that risk?
Absolutely. I mean, you always have to think about risks. I would say that for the capex numbers that are announced today, a lot of those are based on actual projects that are either locked in or getting locked in, and equipment that's getting locked in. So our companies, the suppliers of equipment, are telling us that they're now sold out 3+ years out. So that kind of tells you that whatever is in the backlog for them for the next 3 years, there is pretty high confidence that that's going to get invested. Now, you do need to be worried about, hey, are these companies seeing the returns on invested capital that they originally expected? And is there a way for them to pull back? And sure, there is a possibility, but if you actually look at who is performing well in the market, the people that are surprising the most in capex are doing the best. So if you look at the latest earnings releases, Google had on percentage basis the largest capex surprise, right? And they are the best position, in my opinion, out of the three. Amazon came in the middle. Microsoft has been really lagging, which is surprising because they were the original company to come up with ChatGPT, with their ChatGPT and OpenAI investment. So you would have thought that they would be spending ahead. I think the fact that they're not, it's really hurting them. So we're seeing a clear correlation between who is spending money and how they're performing and expected to perform. So I think that kind of gives us a little bit of comfort here that there is really no way for somebody to stop spending and still compete in the market.
Ivana, such a pleasure. We've learned so much, such an action-packed interview. I appreciate it. Thanks so much for joining me.
Thank you.
That's Ivana Delevska of Spear Invest. Don't miss our next episode. It's been all about the U.S. markets for the last 15 years, but over the past year and in 2026, the U.S. is like in a ranking of 92 markets is 69th in terms of performance. So we're going global. We're going to talk about global market opportunities and emerging market opportunities with Matthew Strauss of CI. Make sure CI Global Asset Management. If you've got questions on any emerging market themes or specific stocks, email questions@inthemoneypod.com, and we'll see you on the next episode.